Jenny Brown. Welcome to this, our last MFB news of 2024. Not going to be here next week because I am going skiing. So I expect, and I will be back in January to catch up with you all again. Maybe I will have some kind of plaster adornment on an arm or a leg, but fingers crossed I won't. Hope everything's good with you guys and you're feeling suitably festive and getting really geared up and organised. There is so much to do for Christmas, isn't there? We've kind of really landed ourselves in this year and we've got 17 people over on Christmas Day. So by the time I get back from skiing on the 21st, it's all going to be of a last minute panic for me. I hope you're feeling slightly less stressed about the whole thing than I am. Would help if I was organised, wouldn't it? But you know, that's a minor detail. Now, in terms of what we've got for you for this, our final episode, we're going to do our usual kind of roundup on interest rates. We're going to do a kind of summary about where mortgage pricing is as well. It's all very well talking about things like swap rates, but actually what does it mean for you? Where are rates sitting currently? How do we leave this year? What are mortgage rates looking at? We've had an interesting round of criteria changes from one of the kind of more challenger bank type lenders that I want to run through with you just because it raises a couple of interesting points. We're then going to dive into the latest regional data from the Mortgage Works, which is going to kind of really tell us lots of interesting information by region about landlords in the UK. How are you feeling? What are you up to? That kind of stuff. And then finally, as it's Christmas, we're going to have a quiz. Who doesn't love a quiz at Christmas? It's just for fun, but I thought it'd be a nice way to kind of round off, let's be honest, what's been a pretty kind of average year. So that's what we're going to be going through this week. It's lucky, actually, that this is our last week for the year because we're going to quit while we're ahead, I think is how I would explain it. Can I also just say I'm really sorry, I've got a really awful cold. I'm like one of the gazillion people in the UK who's on their like 30th cold this winter. I just seem to be going round and round in circles at the moment. So sorry for sounding grotty. Okay, so swap rates. So 2-year swap rates as of last night were at 4.04%. 1 month ago, 4.2%, and 1 year ago, 4.58. So we are absolutely ahead of the game year on year, and actually even month on month things it's certainly feeling a little bit more comfortable. And a really, really similar story with 5-year swap rates. So 5-year swap rates are at 3.76. 1 month ago 3.97 and 1 year ago 3.99. So actually, again, as we can see, things are improving, not drastically by any stretch of the imagination, but that kind of spike that we saw post autumn statement and Trump election has kind of calmed down now, which is really, really good. So what does this mean for you? So first of all, we have basically just seen a load of lenders cut their rates in the last week, which is really fantastic. Again, because swap rates have come down by, month on month by circa 0.2, we're not going to see anything drastic, but actually things have kind of gone back in the direction that they were pre the spike after the autumn statement. So first of all, we've seen Fleet Mortgages reduce their rates by 0.15%. We've seen Kent Reliance drop their rates by up to 0.25. We've seen Precise drop HMO rates by up to 0.2, and they've also introduced some limited edition rates. Land Bay rates down by up to 0.2% and CHL by 0.1%. We've also seen in the kind of more high street lenders, Coventry, BM Solutions, NatWest and Accord Mortgages also all bring their pricing down as well. So in the round, in terms of the direction of fixed rate mortgages, very positive. Now what I've done is I've just done a quick kind of calculation to give you where are actual mortgage rates now. And I've used the scenario of borrowing £150,000 against a property of £200,000, so 75% loan to value. So first of all, just keep in mind, if you were borrowing at 60% loan to value, you could get a lower interest rate basically. The other thing I've done is rather than just giving you the lowest interest rate, which I think is really misleading because as we all know by now, some of these very low interest rates have incredibly high fees. So what I've done is I've focused on those products which have the kind of more palatable, let's say, arrangement fees. So for personal borrowing on a straightforward property, I've focused on those rates which have an arrangement fee of £1,000 or less. So your 2-year fixed rates on this basis is 75% loan to value, personal name, standard property, arrangement fee of £1,000 or less, 2-year fixed rates from 5.19, 5 years from 4.29, and trackers from 5.44%. Limited companies, I've had to kind of change things around slightly. So same kind of metrics in terms of 150,000 on a property of £200,000, but I've had to adjust the arrangement fee slightly. So we're looking at fees of less than £1,500. So your 2-year fixed rates here are from 5.75, 5 years from 5.24 and trackers from 6.09. Now, one of the questions we are being asked all the time at the moment is, should I go for a tracker rate or should I go for a fixed rate? And this is really the $1 million question. Now, in the personal name scenario, tracker rates 5.44 versus a 2-year fixed rate of 5.19. Now, pretty much every single pundit, as it were, in the market is predicting base rate to come down by at least 0.75% next year. And it will probably be a round of cuts kind of every sort of 4 months, basically. So actually, there is a real school of thought that trackers are really becoming a viable option, could make really good sense for people. The downside of trackers and also 2-year fixed rates is we have this kind of more punitive rental calculations. Some people find that actually, despite maybe wanting to take a tracker or wanting to take a 2-year fixed rate, they have to take a 5-year fixed rate because you can borrow more per pound of rental income. But I think if you're kind of in that position where you're just thinking, well, you know, tracker versus fixed rate, the kind of, you know, really key number that you need to remember is that, you know, broadly, without exception, predictions are at least 3 base rate cuts next year. Now, as we know from experience over the last few years, in my word, we have really kind of gained some experience here. Things change and they can change on a dime. So they, you know, this isn't absolutely set in stone, but based on the direction of travel that we're on at the moment, based on the kind of situation with regards to inflation, what's going on in the broader world, that's kind of where people think rates are going to go. Okay, now in terms of criteria changes, we've had one lender who have made some fairly punchy changes to their lending policy, and this lender is the Cumberland. Now, the Cumberland is a lender that we use a lot for holiday let mortgages, and the reason we use them is that they can do holiday lets for individuals and also limited companies. But also they're able to take on some fairly unusual properties. So, for example, maybe a sort of multi-unit, which is a holiday let. And the third reason we use them a lot is just their rates are really, really cracking. So all bases covered from the Cumberland. So what they've done is they've changed a piece of lending criteria, which is that they're no longer stress testing the background portfolio. So what I mean by that is that when you apply for a mortgage, if you've got other buy-to-lets in the background, the lender's going to do a rental calculation on those properties as well as the one that you're bringing to them. And sometimes for those calculations can be the kind of difference between being able to get a mortgage and not. So these calculations can be somewhat onerous. So the Cumberland have taken an unusual, and I say it's unusual because I'm not entirely sure based on regulatory requirements how they're doing this, but I'm sure it's absolutely legit, is that they are no longer stress testing the background portfolio. So if you're a landlord who has been applying for a holiday let mortgage and you have been declined because of the background portfolio, then the Cumberland could certainly be somebody that you guys want to approach. Now, as I was just kind of going through their update where they announced this change, the other thing that they mention is that they're not taking directors' guarantees. So essentially, if you're applying for a mortgage with the Cumberland on a holiday let, I know we're getting quite nichey here, and you are a limited company, they're not going to be asking for personal guarantees from the directors, which is very, very unusual again. Now, in the limited company world, there is only one lender who, as a matter of course, isn't taking personal guarantees when they're lending to a limited company, and that is the West Bromwich. Everybody else will take personal guarantees. So if you're somebody who feels quite strongly about not providing a PG, these could be some lenders that are kind of worth keeping in mind. I have to say, actually, just as an aside, personally, I don't really understand the problem with giving a PG. When you apply for a mortgage in your personal name, ultimately you're on the hook for making sure that mortgage gets paid and the lender gets their money back. If a lender's lending to a limited company, of course they're going to want to make sure that the people that run that business are personally accountable for making sure they get their money back. It's not like you're kind of experiencing a high level of risk or exposure if you're giving a personal guarantee. So personally, I don't really see the problem with it, but we have got actually clients who feel very strongly about not giving a personal guarantee. So if that sits where you're in that camp, this could be useful for you to know. Okay, and another week and another Mortgage Works report, which, as you guys know, I love. And this one is their original snapshot. So this is where they're kind of going around the UK. They've approached loads and loads of landlords who are NRLA members. and they've asked them various questions, and each landlord has responded. And then what they've done is they've collated things in terms of regionally where the landlord is based. So what this does is it gives you a kind of really interesting overview on both the rental market performance and also the kind of sentiment of landlords by region. Now, I can't go through the whole thing because it's like a 15-page report with absolutely loads of data on it, so it would be really boring for you. But what I've tried to do is pick out the key bits of information that I think would make interesting reading for you as landlords. So first of all, let's just take a moment to think about who's actually responded to this report. So as I mentioned, landlords who are NRLA members. The average portfolio size for a respondent is 8 properties with 6.4 buy-to-let mortgages. The average yield on the portfolio across the respondents is 6.5%. And as a kind of group, on average, in the last 12 months, 8% have bought a property, 19% have sold a property, 29% have had a rent arrear, and 38% have had a void period. So that's kind of how these guys' portfolios, which are not insignificant portfolios as an average, like I say, 8 buy-to-lets in the background, that's kind of what they've been experiencing. But breaking this down by region, how does this actually look? So first of all, of the respondents, the landlords with the largest average portfolio size was in the northeast with 11.8 properties. So if you're looking for where in the UK do landlords have the largest portfolio sizes, from this group of people, it's the northeast with 11.8. Now, the highest yield reported is from those in the East Midlands at 7.3%, and the lowest is the East of England at 5.5%. The highest level of investment in the last 12 months has come from those in the East Midlands, where 14% of the landlords there have bought a new property. The highest level of divestment in the of the respondents is in the northwest, where 31% of respondents have sold a property in the last year. Now, just to be clear here, if you respond saying that you've bought a property, it doesn't mean sold a property. It doesn't mean you've sold all of your properties. It means you've sold one property or more. Equally, when we're talking about buying something, you haven't bought necessarily loads of properties, you've just bought at least one. So don't think that every single lender that's responded to this saying, oh, I've sold a property, is divested entirely from the market. It just means that they've sold at least one property. Now, moving on to rent arrears. The area that's experiencing the highest level of rent arrears is the northwest, where 43% of landlords have had arrears in the last 12 months. Now, again, what we don't know is how bad these arrears were. Was it just someone went 1 month behind and then kind of caught up next month, or were these tenants getting really, really far behind? Obviously, it's going to be a sort of range, but 43% of landlords, it's pretty high, isn't it? The highest number of percentage of landlords experiencing void periods is Wales at 53%. Now, again, that figure sounds astronomical, like 53% of landlords have had a void period, but actually what is a void period is that you've had a tenant vacate, so you've had a kind of gap between, filling properties. And as we know, rental void times are at their lowest, really, really low. So actually, kind of how bad is this? But, interesting that Wales actually 53% has seen the highest churn, at least, of tenants. Lowest arrears was the East of England at 22%, and the lowest level of voids was in Yorkshire and the Humber at 35%. Now, moving on to landlord sentiment now, and obviously I love this, the most positive landlords around their own letting business. So the question was, how do you feel about your own letting business for the coming 3 months? The most positive landlords, and this is really interesting, Central London. Not that there's any reason to not be positive in Central London, it's just that London normally, they're the only kind of group who are, with these questions, which are standard questions, they're normally feeling the ones that are most good about the economy. They don't tend to be the most positive, so great that London are feeling super good at the moment. The least positive landlords in terms of prospects around their letting business is the West Midlands at 18%. Confidence in rental yields. So Wales landlords are the most confident in terms of prospects for rental yields over the coming 3 months. 42% of you are feeling good. The lowest was the East of England with just 26% feeling good. Confidence in the prospects of a capital gain over the coming 3 months. The highest was the East Midlands and the lowest was the North West. And lastly, confidence in the UK economy. And funny enough, Central London, 9% of you in Central London are feeling positive for the next 3 months about the UK economy. And then we have a joint lowest, which was the North East, West Midlands and Yorkshire and the Humber. 3% of the landlords there are feeling good about the UK economy over the coming 3 months. So there you go, just kind of shows how things can vary so dramatically by region. And actually, that just because an area is getting one of the highest level of rental yields doesn't mean that these guys are the most confident about them going forwards. So if you are thinking about investing in the next 12 months or so, this data actually can kind of give you a steer about potentially how the market is performing in different regions. If you would like the full report, I'm very happy to share it with you. Please just email in inquiry@mfbrokers.co.uk and we'll whiz that into your inbox. No problem at all. Okay, and my final gift to you, a quiz for Christmas. It's not actually Christmassy, it's kind of related tenuously to the housing market, because I thought I'd try and keep this slightly relevant. It's just for fun. There's no prize, there's no leaderboard. For those uber competitive amongst you, you'll find the answers in the comments section below this video. Do let us know how you got on, and it's around 6 questions. So the first question is, in terms of, as a percentage, the cost increase since 1984, what has risen more in cost, a Mars bar or a house? I know a Mars bar is an interesting one to ask. It's how I always measure the cost of inflation. You know, that's how I kind of do things in my mind. Other people have different things. Some people always use Freddo bars. I think they're like 10p. So it's an easy starting number, but I always work on Mars bars. I'm sure you've got your own thing, but that's where Mars bar came from, because I know it sounds a bit random. So what's gone up in cost more since 1984, a Mars bar or a house? Second question is that in the UK, there's circa 8 million people renting, which is 1/3 of UK households. In Denmark, 47% of people are renting their houses. So actually, we don't have the highest level of renting in Europe. Denmark does, with 47% of people. But which country in Europe has the highest level of home ownership? I'm going to give you a clue. It's not one of the countries you instantly think of. It's like one of the kind of smaller countries. Third question. How many housing ministers were there under the Conservative rule? And just to give you a clue, the Conservative rule was 14 years. So how many housing ministers were there? Question number 4. How many landlords are there in the UK currently? And this is in terms of numbers. And you can have bonus points if you can say whether this is higher or lower than in 2019. So in the last 5 years, are there more or less landlords in the UK? So how many landlords are there in the UK currently? And then how many were there in 2019? Our next question, what was the average age of a landlord acquiring new buy-to-let property with a mortgage this year? So what's the average age of a landlord acquiring a new buy-to-let property this year? And our final question for our Christmas quiz, how much is the average UK rental yield currently? How much is the average UK rental yield currently? And as a bonus point, what is the highest rate of savings you can get on a savings account, or interest you can get, sorry, on a savings account currently? So what is the average yield on a UK property currently? And what is the highest yield you can get on a savings account currently? There you go. That's our Christmas quiz. Look, do you know what? Just to say, actually, it's been a really, a bit of a roller coaster year, I think. For me, definitely, both professionally and personally. So I will be glad to see this one out of the way. I am genuinely thinking that there is a lot to look forward to in 2025. I know that there's also some real headwinds with regards to the Renters' Rights Bill, which is, you know, not to be sniffed at. But actually, when we're speaking to our clients, while people are feeling certainly sort of nervous, what we're not seeing is loads of people saying, you know, that's it, I'm leaving the market, I've had enough, and all that kind of stuff. Landlords are and have proved themselves. And over the last, 10 years, when we think about all the changes that there's been in terms of taxation, legislation, licensing, COVID, so much going on. And actually what we have seen, without a shadow of a doubt, is landlords kind of respond to these changes and work around them. And yeah, of course, there's been a lot of kind of complaining and dissent, but fundamentally landlords recognise that this is their business. They're really, really good at what they do, and they find ways to kind of getting on with their day job without letting things interfere too much. So I think we actually have some really good reasons to be positive and looking forward to 2025. So on that last thought, I will look forward to seeing you in January. Have an amazing Christmas. Really do have a great time with your family and friends. Have a well-earned break. And hopefully I won't be back next year, with my arm in plaster. Look after yourselves and Merry Christmas.